Uh, all right. Well, welcome everyone. My name is Christine Scudder. I'm the Executive Director of Academic Programs, she, her, here at Berkeley School of Social Welfare. And I am delighted today to be joined by our colleague, Joey Atwood from the Financial Aid and Scholarships Office. And Joey has generously agreed to prepare a presentation for our school focused on student loan repayment. And this is a new series that we're offering as a part of our professional development series this semester to support those of you who are graduating to think about the issues of loan repayment. So thank you so much, Joey, for your time. And I will literally pass the mic to you.
Wonderful. You're very welcome. I'm glad to be here, glad to provide this info. We will start off today. We'll focus a lot on just mainly your student loan repayment specifically, what we're all preparing for. So just to start off, this is kind of very general by now. If you are a borrower or you've worked on campus, this is kind of what you've probably seen or expect to have seen in your aid package. These include the federal direct loans, unsubsidized or graduate plus, federal work study if you're a FAFSA filer, but if you're a DREAM Act filer, the California Dream Loan and or UC work study. Those might have been parts or components of your aid package from our office, Financial Aid and Scholarships. But more informational here, just to kind of start with the basics, give you the current rates. If you have borrowed this year, this is what you could expect your loans whenever they are actually accruing interest. They have all of the interest rate payment pause we'll talk about later a little bit. When that's not in effect, this is the rate that they will be in effect when they go into repayment and interest is accruing again. So after the lifetime as being a student, your loans are getting ready to go into repayment. You're going to get notified here soon, if you haven't already, for some loans about exit loan counseling. So if not, that's the first nudge to say you've borrowed loans, or it's on our records that you've borrowed loans, whether it's federal or institutional like at UC Berkeley, and we need you or want you to be prepared for repayment and make you aware of some of the terms, the conditions, and the benefits of your student loans. So to start off, in general, this is the current, what it looks like whenever you go to access or monitor information about your federal student loans, like through FAFSA, the U.S. Department of Education, or ED, we'll refer to them. All of their loan information in the past few years has been consolidated from multiple websites into this one portal through studentaid.gov. Every individual or borrower, if you've prepared a FAFSA, or if you've borrowed loans, you will be able to log in. It's with your federal student aid ID and your own unique password you've set up in the past. That does differentiate somewhat from like the federal PIN. If you had filed FAFSA several years back, a PIN was still required, but all of this is now consolidated, your current records, anything from the past with Department of Education. And this is kind of the main place where you'll land. And these two tabs at the top, loan repayment and loan forgiveness. A lot of the information we're talking about today throughout the presentation is accessible under these two tabs. Once you're logged in as well, it will customize this information a little more specifically to your loan portfolio. But just to give you an idea of what you'll expect to see, the exit loan counseling will direct you to this website. So if anything, give you a heads up on what'll be coming your way. Here we go a little more specifically. This is the actual exit counseling page, just to differentiate that there is undergraduate and graduate professional counseling. If you have borrowed in the past, whether undergraduate and graduate, or if you just borrowed in graduate school, you'll complete this one highlighted here, the graduate professional student. That should encompass all of your loan borrowing from the Federal Department of Education. Pretty much here, this is what we'll cover for your federal loans. Within the loan counseling, one of the main next steps will be to identify who is your federal loan servicer. So you're repaying the loans that you've borrowed from the U.S. Department of Education, but they have several servicers or third parties, if you will, that will be who monitor and manage repayment individually for your loans. So this is current as of last couple of days. These are their current servicers that they work with. You'll be assigned one individual servicer. This can change throughout the lifetime of your loan. Certain things, like we'll talk a little later about public service loan forgiveness, that can trigger an automatic transfer of your loans. They have specific servicers for specific purposes for some programs or benefits. The main thing is just to know that you are going to get communication during, like after repayment. and into your grace period we'll talk about from one of these entities. And they are a legit entity. They are representing the US Department of Ed, and they've gotten much better about being transparent with their information and making it clear why they're contacting you. But to give you a heads up, like when you log in or you use your FSA ID to get into federal student aid or studentaid.gov, this will be one of the first steps, is to identify your individual loan servicer. Their information should all be available to you once you're logged in as well. But a key piece of just knowing who you're actually making payments to, going to be receiving communications from on behalf of the Department of Education. And then very similar, if you have borrowed other types of loans, what we call UC Berkeley institutional loan funding or state loan funding, like through the DREAM Act application with the California Dream Loan, it is the same process as far as exit loan counseling goes, to know your benefits, the repayment terms of those individual loans. The difference is, to the point of servicers, our institutional funds, any borrowed at UC Berkeley specifically, are managed with our federal loans, or excuse me, not federal, our institutional loan servicer is Heartland ECSI. This is their contact information here. It's a little limited. This is just where, if you land on their main page, account and settings, and then registering, signing in, that will pull your specific information from the past. When you've created your loan account, you've signed a promissory note in the past, all of that you should either be able to register or re-authenticate to get access. Knowing this, though, to the point just on the last couple of slides, they will reach out to you and you'll be getting 2 separate loan counselings. You'll have separate repayments to manage because they are different types of loans. So institutional loans will all be managed by Heartland ECSI. These are the loan types right now from Berkeley: the Dream Loan, California Dream Loan. A Berkeley loan you may or may not have had, but if you were a Berkeley undergraduate, you might have had that in your portfolio at that time. And then possibly a federal Perkins loan. Perkins are federal loans. They are backed by the federal US Department of Education. They're no longer a program that we offer. We've not had Perkins loans actively given to students for several award years now. The Department of Ed sunset that program essentially. We do still have borrowers though, like if it was during your undergraduate time, or if there were other times, at other schools where you maybe borrowed a Perkins loan, that loan could still be living or active, and it will come due again when you're not an actively enrolled student or you don't have the student deferment on your loans for repayment. If it was borrowed specifically at Berkeley though, we will send you exit loan counseling for Heartland ECSI as well. That is considered an institution or a campus-based loan, so it will fall under this realm of institutional loan counseling. So the key piece is, if you have direct loans and one of these kinds of loans, you will have 2 separate counselings to complete. Very similar information, but you will have 2 separate pieces to your loan portfolio for the overall management of repayment and whatnot. This email here, if there are issues once you are actively in repayment, you'll usually want to start with your loan servicer. If it's about payment plans, late payments, anything like that, you'll start with the loan servicer. Our contact at UC Berkeley, though, for kind of if there's questions or disputes about loan balances or things, it's managed through our student billing office, and our partners, they're available at this email, accountconsultants@berkeley.edu. If you are ever in a situation or you are working with Heartland ECI and they direct you back to the school per se, this is one of the best ways or the most direct way to get in touch with the staff who can help you. All right, so after kind of the general pieces of exit counseling, all of the build up to it while you're still currently enrolled, then comes repayment. But a few things we want to talk through just to be prepared for repayment, and just kind of talk through what to expect during the next steps once graduation actually takes place. So the first kind of period or the first transition to talk about is you'll go from having an in-school status for your loans, being half-time enrolled or more, to what's called your grace period. As long as you've never used your grace period before on your loans, you'll have 6 months for your federal direct loans. And any loan period basically that has been used in the past, as long as you've not exhausted the full 6 months of your grace period previously, like maybe possibly a semester off or something, you will have a full 6 month grace period again, starting at effective like your graduation date. The 6 months, though, is basically your time after graduation to get prepared for repayment. And usually the Department of Ed or the loan servicers for federal loans, as well as Heartland ECSI for our institutional loans. By the second or third month of the grace period, they're required to have started to communicate with you and have a number of communications so that you know about your loans, setting up a portal, establishing repayment, choosing repayment plans, all of the kind of information. And we'll go into more detail about those topics, but knowing that you have that downtime, it's not that you graduate and immediately there's a month and you go right into repayment. You will have that grace period, especially on any loans that have been newly borrowed for your time at the School of Social Welfare. The communication from your loan servicers, that's just if you have previously been on or if you've been in repayment in the past, knowing that you should just check up on those accounts, reestablish a password or reset your password if you need to get back into them, but just checking your information, making sure everything's current with mailing, where you want any physical mail sent, if you want all electronic statements, but just so that you are actively getting the communications and you're aware of your loans and all the deadlines that will be coming and the updates. Another topic that can come up during this period of time is prepayment. If you want to make payments on your loans during the grace period, or even now, technically while you're enrolled as a student, a key piece with federal loans is there's no penalty. You're not penalized for making a payment earlier during a period that's not repayment. Oftentimes this is to help minimize interest accrual. It's a little unique during your time with the pause on interest that's happened during the pandemic and whatnot. But it is something that during the grace period, if not before, if you are wanting to try to minimize interest or look at interest on loans from the past, you would want to, maybe consider this, definitely during the grace period. After that, pretty much, once you go into repayment, there's the normal penalties, fees, associated late fees would all apply, depending on your loan servicer or whatnot. Key piece is no prepayment penalty for you. A few things that we'll talk about a little more. We'll go into the repayment plan options in a little more depth. But the student loan simulator here, there's the URL. I've provided URLs to a lot of these. Some of them are a little long, I'm sorry. But the loan simulator is going to be one of the best tools that I can recommend from the Department of Ed specifically for federal loans. When you authenticate, you log in with your federal student aid ID, it will populate your federal loan borrowing so that you can see your specific loan portfolio and really get a true picture, as true of a picture as you can for what each repayment plan might mean. What would loan forgiveness look like for you? Definitely seeing it with your individual portfolio is most helpful. The main reason I say that is there are a variety of repayment plans, as you will see, and choosing an appropriate repayment plan, is one key step. Knowing what helps and what makes sense for you right now, as far as how you can repay, how much you can repay. Do you need an income-based payment, or are you going to be aggressive and try to repay your loans and get them paid off as soon as possible? And I just say that way because that can really, it can affect you down the road with your repayment. Repayment in general will be 10 years if you are set up on a standard loan repayment. If you're pursuing aggressive repayment and then you decide to go into public service loan forgiveness, or vice versa, you make changes, within that base 10 years, just as an example, it can really impact the big picture of your loan repayment and how much you're repaying. The income-driven repayment plans tend to accrue more interest than what you're actually paying. So you're seeing your loan balance grow essentially. So the key takeaway there is just the loan simulator. All of these tools are available to you before and into repayment. And they're really helpful if you are making a change in career or another life decision, really to utilize these and see, is this going to make sense, or am I on track still yet with my repayment strategy and the trajectory you set up. It's not saying it is set in stone and from the get-go, but knowing especially if you're pursuing public service loan forgiveness and income-driven repayment, switching between the two they can work against each other. Otherwise, let's go on here. So to kind of go into the repayment plans a little more specific. If you do nothing after exit loan counseling, or you don't take your exit counseling, anything, the bare minimum or the default that the Department of Education will set you up on with your loan balance is the standard repayment plan. I mentioned just a minute ago, it's a 10-year repayment plan. And basically you're set up with whatever your balance is to repay those loans in full on a 10-year repayment plan or 10-year schedule. That will be what they use ultimately to determine your monthly payment. The standard repayment plan is technically PSLF eligible. It's not set up because if you're repaying in 10 years, public service loan forgiveness is set up also in a 10-year time frame, 120 payments, 12 months for 10 years. So there are reasons, particularly this TEPSLF that I note there. Borrowers who've been in repayment in the past or have, had an undergraduate, taken time off, or have then worked in between, come back. This could apply to some of the loans that are a little older in your portfolio. Just knowing that it exists, and there are two flavors, so to speak, of PSLF. You could have had payments that you were making on those older loans where they were a standard repayment. And so those payments, even though you're still in repayment and the big picture has changed, those will qualify you under this TEPSLF exception. Those payments will help and count towards your repayment clocks. We'll get into a little more of it, and maybe it'll kind of come together when we talk about PSLF, but knowing just key things, if you have older loans you've borrowed in the past and been in repayment in the past, these two things might apply, not just PSLF, TEPSLF, if you're going to pursue that route. A couple other options that are considered standard repayment plans, not as popular anymore, but they exist, and as loan repayment has gone on into the future, we'll say. There's the graduated repayment plan, and there's the extended repayment plan. And basically those are set up for you to have progressively increasing payments, or to take that 10-year repayment term and extend it longer than 10 years potentially. Again, with forgiveness, we don't really recommend these. They're going to work, more for aggressive repayment, trying to get your loans paid off as soon as possible. If not, within the 10 years, then less than the 10 years. There is a lot more information. If you go to the URL here, you can get into the nitty gritty of the different percentages and the different timeframes for each of the repayment plans. Go on here then. Now we'll go over into income-driven repayment plans. From some of the questions we received before this and all during the outreach to set up kind of for the presentation, this is, if I've just assumed, I'm sorry, but my lens tends to be a little more for income-driven repayment, public service loan forgiveness, but all of the information we were just talking about to make it aware that if your repayment's different, if your plans are different, that it is all available and out there with the Department of Ed. But to focus a little more on what some of the questions were geared toward with income-driven repayment, there is a specific page, this URL here from Department of Ed. It goes into the specifics of these plans and when they went into existence and kind of how it progressed over the years with direct loans and whatnot. They're in an order here. In a sense, it's like what's most preferable if you're eligible, but revised pay-as-you-earn, IBR, and ICR. We love our acronyms. If you don't know it from Berkeley, the higher ed as well. There's also income sensitive repayment. The key thing with these repayment plans that are different is they basically, ICR was the first, technically ISR. These FFEL loans are the older loans we'll get into. Income contingent repayment and income-based repayment were two of the original. And basically they look at a different percentage of what we call your discretionary income, or what the Department of Ed defines as discretionary income. This is basically, they look at 150% of the poverty guideline for your state. That changes year to year. And they use your adjusted gross income or the equivalent thereof when they're looking to calculate this discretionary income. The difference with these repayment plans though, and what you're eligible for, is over time, they've gotten more beneficial in a general sense with what borrowers are able to access and steps they can take to access the most beneficial terms, all borrowers from the past to current. IBR, really, if you have older loans, that may be one that's beneficial for you. There's a 15% and a 10% of discretionary income flavor or version, however you want to say, of IBR. But if you've never been in repayment, or if you're looking and going forward with, a full set of repayment, if you've had loans but never really been in repayment in the past, pay as you earn or revised pay as you earn would really be the two I would recommend to start looking at and to focus on. If that loan simulator, if you go to that route, start with these two to see, and then compare to the IBR and the ICR. There may be situations where some of these might make sense, especially if you are going the route, like we said earlier, of aggressive repayment and you're going to try to pay your loans off. Some of those might really make more sense, but in general, with public service loan forgiveness and income-driven repayment, we're trying to minimize the amount that you're paying monthly or get you as close as possible to what makes sense. So there's a balance left over to forgive, or that the largest balance possible is forgiven, maybe is a better way to say it. In the end, though, we will talk about FFEL, the Federal Family of Educational Loans, they are older loans, pre-federal direct loans. If you are a borrower who borrowed loans from the past, like pre-2010 especially, you might have some of these loans. They're not PSLF eligible, but just to mention the income sensitive plan, it is specific to them. It's a percentage as well. But there's key steps with an FFEL loan. If you're going to pursue income driven repayment, we'll talk about consolidation, different steps you'll need to take, which ultimately then make those older loans a direct loan and qualify for all of these, the repay, pay, IBR, ICR. Again, here's the direct source if you want to go in and really get into the nitty gritty, but just to kind of give you exposure and a high level about what's out there. All right, so just a couple more things and we'll transition back into a little more about forgiveness, PSLF, IDR, how those all work. But just a couple of things is to know that after your grace period, in general, you're set up for monthly billing. If you have institutional loans or private loans from another servicer, another school, you might have billing that's set up quarterly. Just know the key piece is if you have multiple loan servicers outside the federal government, it's noteworthy when you're going through counseling to make sure, are you set up on monthly repayment? Are you quarterly? Or if you have options, do you want to switch to one or the other? Just knowing that can potentially, be something you want to factor into your repayment plan and the big picture plan. Oftentimes, at least with federal direct loans, there's an incentive. It's an interest rate reduction if you sign up for their auto debit for your monthly payments. Definitely, you can read more about that when you're signing up or when you're initially going into repayment. Your loan servicers will likely communicate that to you in like the third or fourth or fifth month, right before repayment hits after the grace period. But just knowing that can definitely benefit, depending on what your strategy is, especially if you're in an aggressive repayment, all the more, less interest, the better. That might also apply to institutional loans or private loans. It just would be to check with your servicer. And if in doubt, you can always go back to your promissory note or your master promissory note from when you signed the loan. That will have the specific terms, conditions about what's eligible and what your loan qualifies for, even in the repayment time frame. We've talked a little bit about this, just making sure email and addresses are current. If you haven't ever been in repayment, those first couple months, the key thing is to watch for those initial emails from the Department of Ed. You can log into studentaid.gov ahead of time, like you will for exit counseling. You can keep tabs there, but ultimately to check which servicer you're currently assigned to on there. That's who you'll expect within month 2, month 3 to start to get emails or communications from, and then setting up or reestablishing your access with their portal just so you're getting the communications in a timely manner. We'll go into this a little more, but annual recertification in general is a concept for both income-driven repayment and public service loan forgiveness. Just to know that this happens on an annual basis. Have it under managing repayment. It could probably live a few places, but knowing that it applies to multiple pieces if that's in your repayment strategy. Income-driven repayment, you'll recertify on an annual basis. You're required on an annual basis with the Department of Ed. So they will either ask that you provide a copy of your tax return or pay stubs. There's a couple things with this that you can be strategic, especially when you're first going into repayment. If you have the option and you don't have a position, especially right out the gate, you can they'll give you the prior tax year or the current tax year. So right now we're likely looking at 2021, 2022 now that we're filing, but look when you go to apply and you can use your older tax return that will reflect your adjusted gross income, or if you didn't have any income while you were a student this final year, you can use that to your benefit to set yourself up for a lower or a repayment that reflects your status while you were a student or while you're transitioning from being a student into repayment, into working again, or however you want, however your situation is. You don't have to do that, but that is something to keep in mind. They do allow you to look at multiple tax years at a time when this recertification comes year after year. The pay stubs can also be critical if you're looking at recertifying after some kind of life event, like if you've lost a job, or if your income has gone down significantly. You will recertify and can recertify more than on an annual basis. So if you have a job, you recertify, something changes, your salary goes down 2 months later, you definitely want to do that as quickly as you can with the Department of Ed so that you can get, your loan payment trued up. You're not paying based off that higher income from the previous position. You can definitely get into lots of strategies, but just knowing that the documentation, they will take both. The key thing is I think it's usually at least 2 pay stubs, current pay stubs. The Department of Ed, though, is good. Through your loan servicer, they'll follow up with you if there's any kind of communication or clarification they need when you're filling those out on an annual basis. The public service loan forgiveness, they also have a certification form. It's not required that you fill that out annually, but we'll talk a little more in the slides to come about why that might be a good idea. If you're, the way I look at it, at least in my personal loan repayment, if I'm certifying annually, pandemic exceptions all aside, if and when you're recertifying annually for your income-driven repayment, I tend to just fill out the public service loan forgiveness form at the same time. Submit both. The Department of Ed through your servicer, they'll review and process both of those for you. We'll go into a little more detail though coming up with the PSLF part. These topics won't go into a lot of detail. They're not as nice, but at least want to make you aware they are part of your loan repayment, the potential, life of your loan. Capitalization of interest is something to be aware of. This happens with loans, for instance, when you change repayment plans or when you go from, you change status of your loans. So in school to in repayment. It's a concept basically with the interest that's been accruing separately from your main principal. At the time capitalization hits or when capitalization is required, the interest balance becomes principal. And so then you're being charged interest going forward on a higher principal, what had existed originally, plus that interest that capitalized or got added to that. So the new principal, it ultimately it raises the interest. It's making it more expensive for that borrowing. There are ways to avoid this, but why I point it out here, and definitely read more about this on your own, however much this may or may not apply. If you have a period of time when you're in repayment where you need to go on to a pause or a forbearance, a deferment we'll talk about here in a second. Those are changes in loan status, just like in school to repayment is a change in status. So those events, they may be all necessary, beneficial, but a key piece is just to talk with your servicer, make sure you know the difference of during that time, how much interest is accruing and what that's going to look like specifically whenever the forbearance or the deferment is to end, knowing that's just a piece of it and it will change the big picture of your loans. Timing all aside, but definitely this is something we'll get back to contacting servicers. Servicers can help with all of this if and when, it may or may not apply. Also for servicers, additional or specific payments. This is more so if, say, you're on a plan and you're wanting to pay more, or you're on an aggressive plan and you're wanting to pay on it. The key point of just delineating this is to reach out to your servicer directly. If you're in monthly repayment and you have a quoted monthly payment, you want to make sure you're covering that at least, and you pay that within the balance, the time frame, the due date, everything. If you're wanting to pay more than that during the monthly payment and you're already paid up, contact the loan servicer. They do have specific steps or have a specific way, usually of you asking, I want $500 applied to the principal of, I have 5 loans, but only of these 3. They want to, really get the specifics. And in my experience, the best is to reach out to them if it's any kind of a special request or an additional payment that you're wanting it to specifically hit loans or pay loans a certain way. That can be with the timing. So the oldest one is paid for a few reasons, but knowing it's best just to reach out to them directly if that's, a special case or something you're wanting to do. Deferment or forbearance, we talked a little bit just a minute ago, but those are basically when repayment is actively happening. You basically can take a pause, or there are options for pauses in repayment. The interest capitalization is a big reason to, consider it, and think, do I want to take that on? Do I not? But essentially the forbearance or a deferment will pause loan repayments. Usually the Department of Ed will approve them for up to 12 months at a time, kind of like an annual recertification. If you need to go further, it's not an outright no. They'll just ask you to reapply within a 12-month period so they can reassess your situation. Depending on your loan portfolio or the split of it, especially if you have loan borrowing from an undergraduate time, you may have different options. Certain loans might be eligible for a deferment while others are only eligible for a forbearance. forbearance. The key thing is, like, if nothing else, a forbearance will be an option, but a forbearance is going to keep everything more or less the same. You don't have to make payments, but interest accrual, all of the interest continues to add on just as it has been while you were in repayment. So there's reasons that you definitely would want to and know that these are an option, but just know that when the time and if the time comes, another reason to definitely reach out to your loan servicer and talk through that, get some advice before going forward with that. And then the other final topics, for better or worse, default and delinquency. There's specifics to each kind of loan about the timeframes and what's considered, for you to be delinquent or having defaulted on a loan. We don't want this to happen, but just knowing that there are specifics that if it does, there's specific steps that you can take and work with us as the school, as well as the Department of Education, to get back on track. If this ever happens, say to like an institutional or a dream loan, this is where the account consultants we mentioned earlier, that's where that staff might come in, and they would be a little more essential to keep things moving with us and the Department of Ed. But for your federal loans, the federal direct loans, you'll usually see this would be a time if you do default or you go into delinquency. After certain times, you may see that you've been assigned a new loan servicer. Those servicers tend to work a little more specifically with borrowers in those situations. And all the more there's terms, there's rehabilitation for loans whenever these are your statuses. So even if that happens, you do have options. And just again, to make you aware, if nothing else through this presentation, that there are things out there. Just reach out. The loan servicer is kind of your main point to talk what your current options are at that point and how they can help. All right. So a lot of rambling on. Some of this now may be redundant or repetitive, but to get a little more to the questions that were also asked about loan forgiveness, and just to talk mostly about public service loan forgiveness, but I'll also hit on the current proposal, the Biden loan forgiveness, and then also just a couple other options that, again, they exist, they may or may not apply, but to make you aware of a few things. So to start off, PSLF, Public Service Loan Forgiveness. The essentials with Public Service Loan Forgiveness are that you need to make 120 qualifying payments while you're working full-time for a qualifying employer. We'll get into all of what defines qualifying employment, qualifying employer. We've talked about some of the repayment plans, but payments made under certain repayment plans are the ones that will qualify. Like we said, standard is what this usually is getting at, primarily income driven, but there are standard payments and times where the standard repayment plans, if you've made payments, that those could apply. And the key piece is that public service loan forgiveness applies to federal direct loans. Those other families of loans or other names of loans, specifically like the Dream Loan or any private loan, if you've taken those separately, public service loan forgiveness is not an option. For some loans like the FFEL, the Perkins we'll talk about here in a minute, there are options though for you to get them on track so that they could qualify for public service loan forgiveness. So going right into this, other federal loans may qualify, but you do have to take some steps. The Perkins loan we mentioned, you may or may not, it would be from several years ago, but you may or may not have had one from Berkeley. You might have a federal Perkins loan if you went to an undergrad or you've attended another school in the past. If you have a federal Perkins loan, the key thing is to note it is federal, but it by default does not qualify for public service loan forgiveness. The same goes for these FFEL, the Federal Family of Educational Loans. They tend to be, like we said, pre-direct loans, 2010 or before. Direct loans have existed before that as well, but that's kind of when the transition really started to trickle down. But basically these loans, a Perkins loan, for them to become a direct loan, they need to go through what is called direct loan consolidation. So it basically creates a new federal direct loan, and then that new loan, along with your other direct loans, is eligible for public service loan forgiveness or for that benefit. The PSLF clock, I'll refer to it that way, the 120 payment clock, it restarts whenever a loan is consolidated. That's a key concept. So if you go into repayment and then you realize 6 months down the road, oh shoot, I have a Perkins loan that I didn't consolidate. It's still totally fine. You'll want to consolidate it, ASAP, get that moving, but consolidation does take anywhere from 60 to 90 days, in general, it's with the Department of Education with that process. And so it can get your repayment clocks off slightly. If you go through all of during your grace period, you identify your Perkins loans, you start your loan consolidation during that time, you should be in a situation where all of your loans, including the new consolidation loan, will be set up to go into repayment at the same time. So your clocks will all essentially be on the same time. The thing is with a direct loan or with a direct consolidation loan, you do have to consolidate one existing loan to qualify or to have that loan become a direct loan. So again, the timing, if you do that in grace period or before repayment hits, it can keep your clocks on track, or at the same, ticking the same way, we'll say. But knowing consolidation is essentially, it's required. And if it comes after the fact, it can really start to skew your strategy, or it can just make your timelines be off a little bit. If you have been in repayment in the past, or if you have these older loans, like especially an FFEL or a Perkins, and you have made payments on them and you've made significant payments on them, even if they have a balance due, it's noteworthy to go in and look at the details and see, does it make sense to consolidate this? Or am I close enough? Should I pay this off? It can really depend. There's different loan calculators. The loan simulator can help you as well, but it's just something to note. If you do have older loans, it's a consideration before you consolidate. Once you've consolidated, you can't undo a consolidation loan. So it's just something to be noteworthy of, depending on your portfolio, the time frame of your borrowing. The consolidation application, it is all with, I think I mentioned with Ed, the Department of Ed manages all of that in partnership with your loan servicers. And so the consolidation application, it's its own separate portal, but studentaid.gov authenticating, and it's one of the main options there. It gets you specifically on their process. Institutional and or private loans. I've hinted at private loans some here, but private loans are their own creatures, their own entities, we'll say. But in general, institutional loans being from the school, or private loans coming from a third party, like a bank or a third party lender, they are not eligible to be consolidated to then be eligible for public service loan forgiveness. They are not backed by the federal Department of Ed, or haven't been, so they may have their own specific terms and benefits. It's always noteworthy to go into the promissory note or the loan documents when you originally borrowed the loans, to go back over any benefits or forgiveness options that were eligible or that were out there at the time you borrowed that you're eligible for. It can really depend, but it's just, noteworthy that if you have your PSLF clock and you have these other loans, that you do account for them, and that you can kind of, target if you want to be strategic with paying institutional loans off and keep your PSLF going at the same time. But just knowing that in general, they cannot be consolidated. They can't become a direct loan to be part of that program or to receive that benefit. All right, and one thing to note here, this is kind of specific to the time frame that you all are graduating right now for this 22-23 year. During the payment pause, the Department of Education has had some allowances and different exceptions they've allowed to, like income-driven repayment and how payments are counted towards income-driven repayment, as well as public service loan forgiveness. So borrowers who've been in repayment in the past are basically, they've had periods where they're going in and they're reassessing loan portfolios. So some payments, kind of like we mentioned earlier, you might have been in a standard making payments on a standard repayment plan. And that may change if you've been on an income-driven plan, or if you go onto an income-driven plan. I say this specifically for your class because you will graduate roughly May. And this recalculation, the one coming up is July 2023, for all of this to be reflected by like August, September to loan portfolios. So you'll see some more information in your loan counseling when the exit loan counseling comes. But, consider that, especially if a consolidation loan might be a factor, everything, it may just be beneficial for you to take those actions during your grace period or earlier on in your grace period if they're going to apply to you. You can find more information on this. It's out on the studentaid.gov, one of the main headlines right now when you first access. But knowing it's a special exception, they're going in to make this count, so that, ineligible payments before actually now will count towards the big picture with your loan repayment. And then this is very similar, just to note, if you're not sure, to go through like, what loans do I need to consolidate? Do I not? The things we've talked about that, do this during the grace period or find this out. Just to reiterate, your FSA ID, log into the studentaid.gov portal and check that out. For institutional or private loans, if you do have those, the best advice is, again, to go back and look at your promissory notes. Likely once you're not enrolled, it's again within the 2 to 3 to 4 months, those lenders or those third parties are going to start to reach out to you with their equivalent repayment information. But if you're wanting to be proactive or get a heads up to it, go back to your original documents or from the original time you borrowed. At other schools, if you're not sure about that, my recommendation there as well, I don't think I hit on this before. If it's been at other schools, it's always, if in doubt, ask and they'll say no. But to contact the financial aid office, say if you went to an undergrad in another state or another institution, even just to say, I'm finally going into repayment. Can you confirm I don't have loans? Or these are my private loans. These are my institutional loans. If you're in doubt, they would be your best source to at least start with the financial aid office from that school. All right, so now basically with PSLF, what makes it a qualifying payment and what makes it a qualifying employer? So qualifying payments, this October 1st, 2007, kind of goes with the inception or the creation of PSLF in general as a federal program or a benefit. A qualifying payment that's made after that date under a repayment plan that's qualifying. We've talked about IDR, we'll come through those a little more here. Or the standard repayment plan for the full amount. So when you're on an income driven plan or a standard, what you're quoted, you pay at least the amount they've quoted you month after month and no later than 15 days after the due date. So a timely payments on the due date, before the due date, or within 15 days. And then the other key piece is while you're employed full-time by a qualifying employer. Giving us the segue right into what's a qualifying employer? What is qualifying employment? So in general, qualifying employment comes from government, federal, state, tribal, local government employment. A key piece there is if you are a government contractor. Government contractors aren't considered government employees for PSLF purposes. So depending on the nature of your employment, but a full government employee from whatever level there would be eligible, as well as nonprofit organizations. So in general, how that's defined for PSLF is they're tax exempt under Section 501c3 of the Internal Revenue Code. There can also be organizations that aren't tax exempt under 501c3, but they do provide a qualifying service. That list of qualifying services is quite long, and this, can really depend if that's the route or the nature of your employment when the time comes. So all reasons I say, if you're in doubt, you can check. There's the PSLF help tool we'll talk about that you can look at and kind of gauge from past employers or past borrowers who've certified to see if your employer is out there already. But if you're in doubt, to fill out a public service loan forgiveness certification form and have that sent in and have the Department of Ed from the source check to determine, are they a qualifying employer? Another key piece is the full-time aspect of this. So generally, to be considered full-time, it's whatever your employer's definition is for a full-time employee, or at least a minimum of 30 hours per week, whichever is greater. So 30 hours, if your employer defines that differently, as long as it's a minimum of 30 hours. Another difference here is if you do work multiple part-time jobs, and both jobs are eligible, PSLF eligible employers, as long as the total hours total 30 or more, you'll have the equivalent thereof for full-time status. So the 30 can really depend more, in different situations. If you really to get into on the PSLF, there's the PSLF help tool, and on their website, really for the nonprofit specifically, if you want to get more into, what jobs qualify or get some, some of that exposure to past borrowers information, I would, again, log in with your own FSA ID and then really, start to use those tools just to see, so you're prepared ahead of time. All right, and so a couple of PSLF tips. I've kind of jumped ahead, as you've maybe seen, but PSLF help tool, this is a link right here to the main page. The help tool is interactive. So if you go to, it'll have a couple of links for you to get general info, but for you to actually utilize it, it will have you, if you get to the main page, it'll have you log in or authenticate. Very helpful though. If you're going to go through and 100% that your PSLF, your employer is qualifying, once you're logged in, you can go ahead with this tool and you can start the process basically for the first time or every year. You can be logged in and you can create the employment certification form through the Department of Ed's website and everything through the help tool. It helps with data entry, if nothing else, and pulling over, especially if you stay with one employer from year after year. Once you're in repayment for several years, that can definitely be helpful too. Key piece though, right now, MOHELA is one of the servicers from the federal list for federal direct loans. MOHELA is now ED's official servicer for public service loan forgiveness. So you may already be with MOHELA. If you're not, and then you do decide to pursue public service loan forgiveness, you will be transferred to MOHELA by filling out the employment certification form for the first time. It won't happen automatically until you have filled one out and submitted it to the Department of Ed. But if you're, say, with another servicer and then you fill this out, it will trigger that handoff automatically. So there will be a period of time you'll get communication from your existing servicer, and you'll start to get picked up and start to be communicated with from MOHELA. After that, once that initial transfer happens, short of anything changing at the high level with Department of Ed, you'll stay with MOHELA throughout the life or throughout the public service loan forgiveness term, whichever will apply. If you have been a borrower in the past, just to be totally transparent, this did change during the pandemic. Fed loan servicing was the servicer for public service loan forgiveness up until pretty recently. So knowing if you have pursued this in the past, or if you have some of your PSLF clocks have ticked forward, you will have a transition if you haven't already. Likely if you have been in the past, you've been transitioned, but just knowing that this did change, just to make mention there. Also, we talked a little bit the temporary expanded PSLF or TEPSLF. By filling out the employment certification form, this is my main point to drive home here. By filling out, regardless of if you're eligible for one or both, that employment certification form triggers the review at the Department of Ed level for both. So by filling that out, especially if you're a borrower with loans from the past, this will definitely, it's not that you have to fill out a separate application. This will cover you for all of those so that you get credit for like the temporary recount or the one-time recount I mentioned before, so that you get credit for all of those which apply to your specific loan borrowing or your loan portfolio. But knowing it's not a separate form, that's been somewhat of a confusion, but you'll be qualified and you'll be reviewed for both by submitting that. Let's see here, just check my notes. Okay, a couple more things. I've harped on it a little. The help tool. I really like the help tool, if nothing else, to not have to fill one out manually. But the help tool, once you get that form filled out and everything and produced, you basically work with your payroll or your employer to get it filled out and certify your employment. This is kind of the annual basis or that annual recertification, like income-driven repayment. That's where I say, line these up if nothing else, if that helps administratively on your side. Best practice, I say, is to submit it on a yearly basis. That way MOHELA, or however you look at it, Department of Ed, MOHELA for them, is able to look and you're keeping track of your eligible payments. On the portals, whenever you're making your monthly payments, the PSLF count doesn't automatically update. So in a sense, the government's not assuming that you're still in qualifying employment. So if anything else, for peace of mind, I'm visual, I like seeing things or seeing the progress. I say fill one out at least on an annual basis so that you're keeping tabs or you're keeping track, for your records, whatnot, but you also see the progress. You're actually physically seeing that you're making progress towards the 120 payments. Triggering or submitting those basically is what triggers a look and then a recount, and then MOHELA will give it as of that date or however close, whatever the monthly payment is closest to the date that your employer, your HR department certified on that most recent form. A little bit of advice to that. This can just depend on how you like to manage things, but when you start or leave a position, the time frame that you submit to your employer or to your HR department can be, beneficial, critical, however you want to call it. But if you start a job, I recommend at least waiting a month or two or three before you submit that, so that you actually have worked those months, you're on payroll and have worked for that qualifying employer, and you've had qualifying payments take place for PSLF. If you submit it and everything, great, it may trigger the transfer if you're not with MOHELA. But really so that you actually get credit or you submit one when you have qualifying payments. So usually month 2, month 3 at a job, give it, whatever time, or just set that as a reminder, at your, if you have a quarterly check-in, something like that with your supervisor. It can depend who will sign off on it. If the Department of Ed wants clarification or wants somebody else, they'll reach out to you before fully accepting the certification form. But once it's all completed with an employer, whatnot, it can always be submitted to MOHELA through their portal. They have a secure document upload, whatnot, that can help with that. The other thing would basically be if you're leaving give time for your final pay stub, everything to come, so that you actually have it all lined up and you know you have your payments accounted for when you've left that employer. And if anything else, if something were to change, they were to close down the road while you're still pursuing PSLF, you have your qualifying payments documented for the time you were in service with them. All right, so transitioning a little bit, we've talked about public service loan forgiveness. This one has been a little more pertinent, and I won't go into the details of it so much due to the current status, but the one-time student loan debt relief or Biden loan forgiveness, however you want to call it, is a fairly new concept that we're hoping will go forward, but right now it's blocked. The forgiveness, if you've applied or if you were eligible for some, it hasn't been able to move forward. This would be one-time debt forgiveness, different from like the nature of public service loan forgiveness or an annual certification. Basically, it was as of March 7th, the courts had issued the orders were still blocked. So we've not seen any progress yet with this, but if and when this does go forward, here's some of the specifics of the eligible loans. This is also directly from the Department of Education. Just a key thing to note is private loans are not eligible. That's been one, piece of banter, discussion, whatnot, but just to provide you the information, because if and when this all does go forward, if you have loans from the past several years, part of your loan portfolio at least would be eligible, would fall under this, all other requirements met. Here's a little more about the specifics of it. So $20,000 in relief for the one time if you were a Pell Grant recipient, if you ever received $1 or more of Pell Grant and you meet the income requirements. As of, I think March 7th is what I put on here last week. These are the income requirements posted by Department of Ed for the program. And so then you're still eligible, if you didn't have a Pell Grant, up for $10,000 in relief as long as you meet the income requirements. And then the other piece here is the key is that we've had students, if you borrow a new loan or whatnot, is that eligible or not? But it's only for loans that were issued or paid out on or before June 30th, 2022. Anything for this new year was not, essentially. One other thing here to go back. I think I have it on here. There's a way that you can subscribe. I don't know if I see it here. I might have it hidden. If anything, I don't know if it's on here. I might have taken this off, but if you're wanting to stay timely with updates on this, if you go to studentaid.gov, at the very top, there's a header specifically about the one-time debt forgiveness, lots of pertinent information if you want to read the historical as well. But there's an option to subscribe to updates. There's a lot of updates, more than you may want from Department of Ed. Might be some others of interest, but loan forgiveness or loan repayment specifically is one. If you subscribe, they'll keep you updated or send you updates timely whenever actions taken or next steps do move forward for the one-time debt relief. Another option, this may or may not apply, but just a couple noteworthy things. Teacher loan forgiveness is a separate program from public service loan forgiveness through the Department of Ed. Federal direct loans do qualify. The specifics are, a little different from PSLF, teaching full-time for 5 complete and consecutive academic years. Certain low income schools, certain schools will qualify. So it is kind of a specific program in and of itself. The eligibility is capped. That's another thing to note, but a key piece, if nothing else here is, whether or not this applies or not. You can't be working towards teacher loan forgiveness and public service loan forgiveness at the same time. They do have to be separate periods. So if or when this does apply, it would be something I would definitely, again, recommend talking with your loan servicer, talking with somebody, even a little more specifics. If you have past teaching credit and you're incorporating this, you might want to get a little more hands-on with your loan portfolio there. The key piece though is just PSLF and teacher, they can't go on at the same time, basically 2 separate periods for that forgiveness. All right, so basically a lot of information there. There's plenty of others that may or may not come up during your exit counseling afterward. So if you do need to get in touch with Berkeley or you have questions for us, this right here is our main page with Cal Student Central, our partners. That's kind of our front desk or the way to get in touch with any of us for student services directly. I give all the different ways here, but once you've graduated or you've separated, your access to Cal Central and all will eventually taper off and it will get deactivated or switched over to alumni access. So if that happens, or if you're not able to open a case or your CalNet ID is not authenticating, the link highlighted here allows you to still submit a case to get to us, virtually that way. If calling doesn't work, but that we can ultimately still get a request in. While you're still a student though, open a case, the button up here should work, bottom line. But this is usually the best way to get in touch with Cal Student Central, and they'll filter all of your requests. If it's about billing, they'll get it to the student billing office. If it is about loans or loan repayment or balance, they'll get it to us, but they work with the different offices, the registrar as well, depending on, who you may need. Their phone hours are here. They do change from time to time, so there's the main link as well to their main page. But anything Berkeley specific about your time and while you're a student, definitely, this is your way to get in touch with us and our staff. And again, I included some of this from before. These are just, to remember, if you have questions about your loan specifically, once you're in the grace period or you're in repayment, if it's really heavier on the side of, can I change my repayment plan? Would this be more beneficial? Your loan servicer is going to be your best resource to know what your current options are. It's not to say we can't give general information, kind of make sure, you're aware of where is your loan servicer, who is. We can definitely try to help with all of those things. But when it comes to more specific about like a PSLF form or an income driven repayment certification, that's where we do, have to hand off to the government or to your loan servicer for their expertise, their next steps. But just to reiterate, these are the federal direct loan servicers as of right now. The UCB institutional, albeit this is really small now that I see it, Heartland ECSI, their contact info is on here, and then private alternative loans, to make sure you're aware. If you're not sure, check with financial aid offices to make sure if you borrowed those or not, or look at your promissory notes, your loan documents, so you know who you've borrowed the funding from and what to expect with that private loan repayment. And with that, I think we got through pretty quick, but just to give you a high level, at least some exposure, I'm very glad we had the opportunity to provide this information, just, establish our relationship a little more, if nothing else, so you're aware who we are in financial aid and, how we can help if it's still during the time while you're a student and on into the future with your loan repayment. But with that, thank you all for having me, and I'll pass it back over to you, Christine.
Thank you so much. Again, Joey Atwood with the Financial Aid and Scholarships Office here at our own UC Berkeley. Just really want to thank you, Joey, and appreciate the specific, informative tips, strategies, and really concrete resources. As social workers, we appreciate that, and we know it when we see it. So thank you so much for taking the time to really break it down. It was really generous of you to give of your time in these ways. And we're looking forward to not only posting this video for all of our students, but also posting your slides. So thank you so much for all of the content that you shared with us, and for giving your time to our school. So thank you.
You're very welcome. You're very welcome. My pleasure. If anything comes up, we can help. Please reach out to us. We're happy to. Thank you again.